Let's say you have a covered call and it's in the money, and the underlying stock pays a dividend. You've heard that sometimes covered calls get called away early, and this is true. A common reason is because of dividends. Should you be worried? We're going to explore this situation and offer some thoughts on what you can do if you find yourself in this situation. I like to use real world examples rather than just talk about things in the abstract. And as luck would have it, I happen to have a covered call in this situation. It's fairly deep in the money, and the underlying stock has a big dividend. So we're going to take an in-depth look at it. Here's a chart showing all my transactions with Altria, the old Philip Morris cigarette company, symbol MO. It pays a big dividend, currently yielding 8.14% annualized. Keep in mind that we need to adjust this yield when we have in-the-money covered calls on our stock, and we'll discuss that in a couple minutes. I bought 100 shares of MO back in January of 2024 for $40.02. I immediately sold a leap call on it and got a $1.44 premium. It's at a 42.5 strike, that's this red line here, with a January 2026 expiration. That's a year beyond the end of this chart. You might think that's a low premium for such a long-dated call, only getting $1.44. It was only a little above its price back when the call was sold, and its expiration was 2 years out in the future. And you're right, it is kind of low. But you don't get much premium for high dividend stocks with low volatility. You're expecting or hoping to make money from the dividend with the stock price remaining fairly steady. And you're just trying to boost your returns a little with the premium. So far, I've collected two 98-cent dividends here and here, and we'll collect another dividend of $1.02 on October 10th here. Its ex-dividend date has already passed, so that dividend is all mine. That will bring my cost basis down to $35.62. Most stock has done great over this time period, significantly better than I expected. It blew past my 42.5 strike and remains comfortably in the money this far at the time of this episode. The expiration is still over a year away, and it's over $7.5 in the money with a very big dividend, which means it could get called away early, probably just before a future ex-dividend date. One just passed in September, and another is coming up probably sometime in December. And that's the current state of things. So let's take a closer look at why it may get called away early. But first, if you're enjoying this content, please consider liking and subscribing. Recall the intrinsic value of an option is the profit the current option holder would make if she exercised the option immediately. That's the current price of the stock minus the strike price times 100. Why? Because after she executes and buys those 100 shares at the strike price, then she could go sell them at the higher market price. So that's currently 50.1 minus the 42.5 times 100 equals $760. And I forgot my parentheses. Do the subtraction first, then multiply by 100. Now recall that an option's time value is the additional amount above the intrinsic value due to the time remaining in the option. It's also called extrinsic value. Why does a covered call have time value? It's because a call option can only go down to zero, but has unlimited upside. And traders are rightly willing to pay something for the bigger upside potential. So the time value is the current market price of the option minus its intrinsic value. Here it is currently $840 minus $760, or $80. As the next ex-dividend date approaches, which will probably pay another $102, several scenarios could play out. One possibility is that most stock could continue to go up. If that happens, then its time value will go down because of the increased downside potential of the option, offsetting more of the unlimited upside potential. At some point, the time value may go negative because of the $102 dividend paid to the owner of the shares on the ex-dividend date. Let's think about it from the buyer's point of view, the person currently owning the contract. Would she want to execute the option early right now? If she were to execute the contract right now, she could sell the shares and make $760 profit, the intrinsic value, or she could keep the 100 shares and collect all future dividends until she wanted to sell the stock. Let's assume she's rational. The first choice makes no sense because she could sell the option for $840. The second choice isn't bad if she wants to own the stock long term, but requires that she spend $42.50 in capital to buy the shares. That's the strike times 100. And she forfeits all future time value, which is $80. She's more likely to not execute early. She could either sell the option for $840 or continue to hold the option, speculating that the stock goes higher. This could change as the ex-dividend draws closer. The dividend could become worth more than the extrinsic value of the stock upside. When that happens, it will make sense for her to execute the option and sell the shares, or collect the dividend and then sell the shares. She'll see this when the option's time value goes negative. Collecting the dividend isn't a big deal because dividends are built into the stock price. The stock price will fall by the dividend amount on the ex-dividend date. So you could sell the shares for more before the ex-dividend date, or collect the dividend and sell the shares for less after. It's a wash other than short-term price fluctuations around that time. It only matters if you'd prefer to have your wealth in cash or stock. Moving on, as promised, let's talk about dividend yield on in-the-money covered calls. A stock's quoted dividend yield is based on its current market price, but we have an in-the-money covered call, so we probably won't be selling it at its market price. We need to compute our dividend yield differently when helping to determine an appropriate action on our in-the-money covered call. I like to think about a couple different yields instead of the market price dividend yield before making a decision on whether to close out my in-the-money covered call. First, there's the closeout yield. It's similar to the 7-day yield you see if you have a money market fund. It'll change daily. You can compute it from your current closeout value. Your closeout value is the current value of the stock covering your call minus the market value of the covered call. So in our example with MO, the closeout value is 50.1 times 100 minus 840, the current value of the call, and that equals 4170. Plugging that into a simple yield formula for 1 year of dividends, you'll get this, dividends divided by closeout value. I'm going to assume Mo will pay 1.02 a quarter. We'll get $408 in dividends. We'll divide that by the closeout value and get 9.78%. You'd add this yield to the remaining annualized yield on the time value of your covered call to see how much your in-the-money covered call is yielding. If you'd like more details on this, I go over how that works in other episodes linked in the description. Back to dividend yields. Second, there's the strike yield here at the bottom, which is the yield if we end up selling at the strike price like we expect. Doing similar calculations as the closeout yield, we get 9.6%. Which of these yields is the best when deciding whether to close your covered call? It's a good question, and I leave that to you. They should be pretty similar for deep in the money calls. The closeout will typically be a little higher because the remaining time value gets subtracted from the denominator. Keep in mind that as your covered call goes deeper and deeper in the money, both of these in the money dividend yields will get larger compared to the market price yield. Another way to think of it is the market price yield will get smaller because the stock price has been going up. That's why the call is in the money. But your in the money covered call dividend yield won't change as much because the underlying stock's max price is locked at the strike. Some last thoughts about covered calls and dividends. Sometimes your time value will go negative and it won't execute. Here's a couple reasons why. It's not a large enough amount to cover the transaction costs and effort required to execute the covered call. Or it's not liquid, so there's a big spread between the ask and bid. The quoted price makes the option's time value look like it's gone negative, but it really hasn't. And finally, getting called away isn't such a bad thing. There's no transaction cost. It frees up money for other opportunities. You pay no time value. And you're not really losing money by missing out on a dividend because the stock goes down by the dividend amount on the ex-dividend date. In conclusion, please let me know in the comments your thoughts on this episode and if you found it helpful. Do you disagree with anything I presented? Did I miss anything important? How do you think about dividends for your in the money covered calls? I really appreciate any feedback or comments. If you enjoyed this content, please consider liking and subscribing. I'm not a financial advisor. This isn't financial advice. This is just some guy sharing his thoughts about in the money covered calls and their dividends. And have a profitable day.